Well, hello and welcome to News Center. I am Ashmit Kumar. Now, the big story this evening, what does 2024 hold for India's economy? CNBC TV18 polled the country's top economists for their outlook on growth, inflation and interest rates in the new year. Now, 60% of the economists polled expect growth rate to be between 6.2 to 6.4% in FY25. Ritu Singh is joining us now with the key findings of the CNBC TV18 poll. Over to you, Ritu.
Well, thanks, Ashmit, and a happy new year to you. Well, the global economy went through what was a tricky 2023. It took a few hits here and there, but fared okay overall, with expectations of a soft landing in 2024. So in this environment, we asked a bunch of economists how they see the economy shaping up as we step into 2024, and here's what our poll threw up. The majority of respondents are expecting the Indian economy to grow between 6.2 to 6.4% in FY25, which is around that 6.3% mark that IMF has projected, for instance. Now, a third even see the GDP touching a rate of 6.8 to 7%. Now, government spending, that is expected to remain the biggest driver of growth in 2024, even though there have been talks of private capex picking up from the RBI governor recently, for instance. The majority believes that the government's fiscal deficit will also come down marginally from 5.9% targeted for FY24 to around 5.5 to 5.8% for FY25. Now, the rupee has been resilient this year compared to what we saw in 2022. And going ahead, majority of our respondents expected to trade between 82 to 84 to the dollar in 2024. Inflation is widely expected to average around 4.5% to 5%, still a tad higher than that elusive 4% midpoint which RBI has been targeting. Now, speaking of RBI, the first repo rate cut is expected in the second quarter of FY25 by most, and even later by some of the others. Half our respondents expect the repo rate to touch 6% by the end of 2024. Now, the one place where all of the respondents were absolutely unanimous was the 10-year range. That is seen at 6.75 to 7% by the end of 2024. So that is how the Indian economy is expected to shape up in this year. Joining me now to take the discussion forward is Madan Sabnavis, Chief Economist at Bank of Baroda. Mr. Sabnavis, thanks very much for being here with us and wish you a very happy start to 2024. What is your reading of the current macroeconomic environment? It's an important year. We're heading into general elections in a few months. Our poll shows the majority expecting GDP in the range of 6.2 to 6.4% for FY25, and driven by the government spending and not private, capex or consumption. What is your reading?
In fact, Ritu, we have a slightly different view because we are looking at GDP growth in the region of 6.75 to 6.8%. So at that 6.8% is where we are actually placed. And the reasons are quite different because we do think that all the preconditions to higher growth has been achieved in the current financial year. And when we step into next year, I think there would be some bit of acceleration taking place on two scores. One is, of course, in terms of consumption, and the second one is on investment. When we're talking of consumption, we are assuming that there will be a normal monsoon. And given the fact that agriculture has not performed in 23-24, we would expect the base effect as well as a good monsoon to drive rural demand. Because I think that has been the piece which has been missing in the consumption story so far until December. And I would tend to think that this is something which will change. Second, when we see that the consumption cycle has changed, with rural demand also picking up, we could also be expecting private sector investment to pick up. Now, today, if you look at private sector investment, it seems to be laden more towards the infrastructure-based industry. So it's very much one-sided. It becomes slightly more comprehensive when we are looking at 23-24. And that's what gives us the optimism that good agriculture, revival in rural spending, private sector investment picking up to a certain extent, especially in industries which have not seen too much of interest from private sector. That is actually going to push the growth rate closer towards the 7% mark in 23-24. 24-25, sorry.
I see. So you're a tad more optimistic than... Okay, you're a tad more optimistic than what our poll had thrown up. But globally, it's been a difficult year, whether it was geopolitical tensions or central bank rates staying higher for longer than expected, inflation continuing to be a spot of bother. But India was relatively a better performer. What, according to you, are the biggest tailwinds as we start 2024? The last GDP print, of course, took the street by a positive surprise.
So again, I have a slightly different view. I think Indian economy is a domestic-oriented economy, and that's one of the reasons why there is a bit of decoupling which takes place, notwithstanding what happens in the global sphere. While exports of goods and services is something which definitely adds that delta to the overall growth process, but intrinsically, I think having a large population, a large consuming class, I think that is something which made sure that the Indian economy continued to do well in the last 2 years, even though we saw that the global economy had all kinds of problems on account of the Ukraine war, global prices going up. And to add to this, I would say the response of the government as well as the Reserve Bank of India has been very, very proactive. And I think that is something which has actually held the economy together. The time when the private sector is not spending, we saw the government coming up and pushing forward with capex, both the center and the states to a certain extent. And in terms of the RBI, I think we had one particular advantage is that when we rolled the repo rate down to 4%, that was an abnormal situation. And what we have taken it today at 6.5% is actually the average what we have seen in the last 10 years. So therefore, higher interest rates has not really come in the way of the growth process. Whereas when we look at the world economy today, I think one of the reasons why it is generally believed that the world economy will slow down in 24 compared to 23 is that the higher interest rates is going to start taking an impact on investment decisions. And that is something which could slow down growth. We won't be having that kind of a situation in India. I think those are the tailwinds which are really going to help us to go towards the 7% mark.
Okay, and what about the biggest headwinds on the flip side? If you could list down the top 2 or 3 risks that the economy faces today.
I think the biggest risk for us is inflation, because we always start the year on a sanguine note saying that we'll have a normal monsoon, inflation remains normal. Now, well, I don't think there's too much of fear of core inflation really picking up in the next financial year. But there's also a case of agriculture, because we've seen even in years when we had good monsoon, there are certain specific food products. It could be pulses, could be cereals, could be oils. These are the ones which have actually spiked up inflation. So I think inflation remains the biggest risk for us. I don't think we have any other risk factor on the domestic front, because even in case the assumptions which I spoke about, consumption and private sector investment, do not revive the way in which we are expecting, we would still see the growth remaining in the region of around 6.5%. And globally, of course, there will be a case of saying that if we again see global prices going up, on account of any factor. I mean, oil is always something which we assume will remain in the region of around $80 per barrel. But suppose something untoward happens and the price goes up, then we will have repercussions all through the world. And the second thing is, of course, if the Federal Reserve does not bring about the rate cuts, then I think there would be a bit of turbulence both in the bond market. So today, when we're talking of the 10-year GSEC going in the region of 6.75 to 7, it is premised on the fact that the Federal Reserve also does do the 2 to 3 rate cuts next year. So I think that would be the second risk factor, because it will also have implications on the currency, and the so-called stable currency, which we're talking of in the region of 82 to 84 per dollar, is something which could get upset in case we see things working out the other way as well as the US is concerned.
Okay. So more external risks than domestic. Inflation, you're saying, is the only domestic risk you'll watch out for. Speaking of inflation, given that, RBI has made it very clear that until we get to that 4% midpoint consistently, the rate cycle may not turn. What is your own expectation? Where do you see the repo rate by the end of the year? And when do you when you expect the RBI to start that rate cutting cycle?
Yeah, actually, what you've said is right. The RBI has said that the goal is not 5% and it's 4%. And in case you look at the forecast which the RBI has put out for inflation in the next few quarters, we'll be touching at 4% only in the second quarter of next financial year. So that's one of the reasons why we feel that the rate cut could happen only at that particular point in time. And assuming that we remain in that 4 to 5% range, there could be a maximum of 2 rate cuts next year. But I think when the RBI says 4%, it does not mean that until we touch 4%, we will not be touching the repo rate. I think it's more the trajectory and factors which go behind the inflation number, which will lead to the RBI decision on changes in the repo rate.
Okay. All right, Mr. Sabnavis, before we let you go, one final word. We just have 10 seconds to go. The big event, of course, that the markets will be watching out for is the election, the general elections in a few months. How do you expect that to impact the deficits, the general and the state, larger deficit that the government is targeting?
No, actually, out here, I'm very, I would say, again, I'm very positive when it comes to the fiscal side, because we have seen in the last few years that irrespective of what the size of the fiscal deficit, what the ratio is, we've seen that the borrowing program of the government has gone on quite smoothly. It hasn't really created any kind of crowding out effects. So I would tend to believe that the government would be continuing on the path of fiscal prudence, and therefore there would not be too much of pressure. And the FRBM would make sure that the state governments don't exceed their fiscal targets.
All right, so you expect fiscal deficit to be contained despite the election year. Mrs. Sabnavis, thank you very much for sharing your thoughts here with us. Been a pleasure speaking with you, and a very happy new year to you again.
Same to you.
Okay, Ashmit, it's back to you in the Delhi studio.
Right, Ritu, thanks a lot for that. A lot of interesting insights. 70% of the economists there expecting Capex to drive growth as far as this next fiscal is concerned. And of course, the big trigger will be the general elections coming up in just a few months' time. With that, we're heading into a very short break, but coming up, food delivery apps ring in the moolah as Indians ring in the new year. We take stock with the food app honchos up next.
For more news and updates, all you need to do is follow CNBC TV18 on all of our digital platforms.